So, we're talking about the City of London. This is an excellent opportunity. This is one of the most exciting places in the world, doing some of the best law in the world. But you have to enjoy this, make the most of this. What I'd strongly encourage you to do is just spend a little bit of time wandering around the city, getting a feel for the city. Just round the corner, 5 minutes away, is the Museum of London. Go and see it. Spend an hour, 2 hours there. There's a large roundabout. Turn right at the Barbican Station. Large roundabout on the top. That's the Museum of London. Go and see it, 5 minutes walk away. 10 minutes walk away, the Bank of England. There's an excellent money museum, banking museum, for free. Go and see that. Holborn, Lincoln's Inn Field, 5 minutes away is the British Library. They have a wonderful gallery called Gallery 68. Left-hand side, up the large stairs, best collection of money you'll see almost anywhere. And you can actually arrange private collections. We're going to have a private visit at some point reasonably soon. But what they actually do during the day is they have a little reception area inside the gallery, Gallery 68, and one of the ladies there very often just brings coins out, and she lets you touch a 1,000-year-old coin, a 2,000-year-old coin, some of the first money in the world. Okay, so get a feel for this. London's a very exciting place, very exciting financial centre. It still is the largest financial centre in the world. On your system, there's a short document on the City of London. Read it at least once, get a feel for it. It's not examinable, but it gives you, lets you know what London is about, gives you a feel for this. I won't go over all of this again because we did it earlier. This used to be called Londinium by the Romans. Romans were here to 410 AD. They had a wall. The wall was 3.5 miles long with 6 gates. You can actually still see part of London Wall on London Wall, which is, as I said, Barbican, turn right, at the bottom, turn left. That's London Wall. You can still see parts of the old wall there. London grows very fast, 1500s. We have the Great Fire of London in 1666. London's largely rebuilt after that. By the 1600s, it becomes the largest city in the world. By the 1800s, the Victorian period, we then start building all the train stations, all the underground systems, and then electronic lifts, so all the buildings get much higher. London really comes together and takes on its modern shape. You can still get a feel for the old medieval centre around the little lanes beside the Bank of England. You can walk around them and you can see like the old beautiful coffee houses. One of the photographs on here is the first coffee house in London, Pascal Rosé in 1652. You can still see it. Bank of England's on Threadneedle Street. Then it's Cornhill, then it's Lombard Street. One block up, Cornhill, it's a little church. That lane is called Exchange Alley. Just down there, there's a pub, a wine bar called the Jamaica Inn. There's a plaque on the wall, first coffee house in London. Did I tell you this before? Everybody in London used to drink all the time. They drank beer or they drank claret because they couldn't drink the water. The water was, you would catch all sorts of dreadful diseases. Most people were inebriated for most of the time until the 1600s. When coffee houses opened, everybody sobered down. And that's the beginning of what becomes a lot of the main periods of growth in London and British society and British history. This is just before what's called the Financial Revolution in 1688. Bank of England set up in 1694. That's the beginning of the Enlightenment in Scotland in the early 1700s. That leads into the Industrial Revolution, 1740 to 1840. Then the Second Industrial Revolution, 1840 to 1920. And then the Third Industrial Revolution is the Digital Revolution after the Second World War. We're now at the beginning of the Fourth and possibly the Fifth Industrial Revolution, which is FinTech. And that's why we're looking at financial technology and research projects. And a lot of that is going to be centered in London. Whatever happens because of Brexit and other things, London will survive. London will prosper. We're going to lose some business to the European continent, some Euro clearing business and some other business. It doesn't matter. All that happens is the big banks doing this, they're all based in London. So they'll just rebook some of their business through Dublin, Amsterdam, Frankfurt, and Paris. That's all that's going to happen. London's still going to stay the same. One of the finest cities in the world. So enjoy it. Now, another little thing to tell you about is for this class specifically, I've given you another paper on the background to the Eurodollar markets. Again, I strongly encourage you to read this at least once, because this is directly relevant to this class. This is the background to this class. Again, it's all on the system. International banking and the Eurodollar markets. So, what I'm basically talking about is what we said before, these Eurodollar. What happens is this: after the Second World War, the dollar becomes the most important currency in the world, mainly because of what was called the Bretton Woods system. The Bretton Woods Treaty is signed on July 1944 at the Bretton Woods Hotel, which is a beautiful old wooden hotel. I've been there. You can still see it. A lot of the photographs are my systems. Not this specific file, but some of the others. They have what's called the gold room, and you can still see it. You just walk in. There's a big gold gilt table with gold gilt chairs, and that's where they signed the Bretton Woods Treaty in July 1944. What was this treaty for? This treaty establishes the International Monetary Fund. It establishes the International Bank for Reconstruction and Development, which we now refer to as the World Bank, and it was meant to try and set up an international trade organization, an ITO. They couldn't agree on that. The Americans couldn't agree, and the French couldn't agree, so they set up what was called the GATT, the GATT instead, the General Agreement on Tariffs and Trade, if anybody's done any trade finance law. So, the three key areas that we wanted international cooperation on: International Monetary Fund, development, the World Bank, and then thirdly, international trade. With the GATTs, we couldn't set the IT up then, but we do set the WT up, the World Trade Organization, subsequently in 1986, and then that's the basis for the international global trading system we have there. What they also agreed at Bretton Woods was, we had the gold standard, and I'll go back over this because it's all in the introductory paper, this one, but I just want to do the Eurodollar markets first. It's in the introduction paper. The gold standard basically goes from 1717 to 1815 on a de facto basis. Britain basically ties sterling to gold, and the gold markets are managed out of London. London's the centre of the international financial system. So we have a stable international system. Britain then formally goes on a gold standard from 1815 to just before the First World War, 1914. First World War, 1914 to 1918. We then tried to restore things just after the First World War. There was a British Gold Standard Act in 1925. That was unsuccessful. We tried to reintroduce the gold standard, but we couldn't, so we abandoned it. And as I said before, a lot of people think the causes of the Second World War were largely because of the instability that was created after the First World War. So what we had to do was we had to try and design an international trading, financial, monetary, and development system for operation after the Second World War. That's what the Bretton Woods Treaty was for. July 1944. What actually happened was, it was agreed between America and Britain, and they invite all the leaders of all the Allied forces, and all these senior gentlemen all go to this beautiful old hotel, which I've visited. And what actually happens is, on the first floor, where all the large suites are, they still have all the plaques. This was the Italian finance minister, this was the Italian prime minister, this was the French foreign minister and the French prime minister, all along. Very exciting, very interesting. And as I say, you can still see the gold room, it's called, where they signed the treaty. Big, beautiful old gold table. Just Google this, go on the system. I'm sure there's lots of links on the QM+. You can learn about this, get a feel for this. This lasts from 1944 until 1971. Richard Nixon is on the radio giving an announcement on the new economic plan after the Vietnam War in August 1971. The American economy is in a very difficult situation. They're spending too much money, they don't want to put taxation up, so what do? They decide they're going to close the gold window. Now what had happened was, under Bretton Woods, for 200 years, we fixed all the currencies in the world to gold, and gold was fixed to sterling. That was the gold standard. under Bretton Woods, we create a dollar-based gold exchange standard. And what that meant was this. We fixed all the currencies in the world to the dollar, and we fixed the dollar to gold at $35 per ounce. Do you see? The gold standard, you tie all the currencies to gold directly. Under a gold exchange standard, you tie them to a currency which is tied to gold. Do you see? Use an intermediate currency. Sterling, we had a sterling gold exchange standard in the 1910s, 1920s. But then we replaced that with a dollar sterling exchange, a dollar gold exchange standard. So we tie dollar to gold and all the currencies in the world to dollar from 1944 to 1971. And that was why after the Second World War, we could rebuild the world, rebuild Europe, and then rebuild the rest of the world because of the stable economic conditions we created. All that then breaks down in 1971. We set up a committee of experts, committee of 20, 72, 73, to try and design a new system. They can't. So from 1973 onwards, we have this new international world we live in, which is much more unstable than it used to be. So this is the background to the Eurodollar markets. The Eurodollars themselves, as we said before, what happened was this. All the big American banks became very profitable, very powerful, very influential. There was large amounts of extra liquidity in America, but the American banks couldn't use it in America because the American system was highly regulated. So what did they do? All the American banks came to London. And that's the basis for the beginning of the Eurodollar markets. The Eurodollar markets then grow and expand with the American banks first, and then all the other international banks all around the world all come to London. And by the beginning of the 1970s, every major bank in the world is in London. It either has a full subsidiary, a separate operation, or at least a representative office. Smaller banks that couldn't work by themselves form what we call consortia. So London was always also full of these consortia. So for example, a number of smaller Italian banks would get together with some French and Spanish banks. They form a group, a joint venture, a consortia, so they can lend and operate in these markets because these markets became so large so quickly. There was three main markets, we said this before. There's a basic, and it's all in this paper, look, it's all here. That's all the history there, Eurodollar deposits, and it's also called the placement market. There was three markets. There was an interbank market so that the big banks could lend dollars to each other. The Americans bring them over from America, and then we just lend them to each other. We also call that the placement market or the interbank market. It's a dollar interbank market. When you lend, you place. When you borrow, you take. Can you see that there? Taking. These are old technical terms. You'll see them in the older books. Most of the modern books don't talk about this because they don't understand it, they don't know anything about it. Most books don't even talk about the deposit market. They just jump into the Euro loan market and the Euro bond market. So, underlying the Eurodollar markets is a deposit market. Basically, the big American banks bring their dollars to London. London becomes the offshore financial center for dollar debt after the Second World War. Out of that then springs these two other markets, the Euro loan market and the Euro bond market. The Euro loan market is where we lend large amounts of money in dollars outside of America. Now, we did this before. So, if it's dollars in London, it's Eurodollar. If it's dollar in America, it's domestic. If it's yen in London, it's Eurodollar. If it's yen in Beijing, it's Eurodollar. If it's rubles in Paris, it's Eurodollar. But if it's euros in Paris or any other major European centre, it's domestic. Euro now refers to any lending of a currency outside the country of issuance. So it's not just dollars, it can now be anything lent in another financial centre outside its own home country, okay? Now, initially, we had the loan markets, the lending markets. I said this before. Because these are so large, one bank will never lend in these markets by itself. Starting prices are 10 million, the absolute minimum. More like 100 million, a billion, 5 billion. So banks form syndicates, they lend in groups. Now, I actually was involved. There's a little tunnel. Anybody know the little tunnel between Paris and London? Not quite all the way, but the Euro tunnel. I actually was involved in that, my law firm. And everybody wanted to be in the syndicate. The syndicate had over 100 banks. So we had a small management team of banks managing the larger syndicate. But when you tried to have a meeting, you had to have all the bankers and all their assistants, and then all the lawyers and all their assistants. You could have 200, 300, 400 people just for one meeting, because this syndicate was so large, so enormous, because everybody wanted to be a part of it, because it was such a high-profile deal, the Eurodollar deal. I actually wrote one of the subordination opinions on that. So this is the Euro loan market. It begins late 1960s, early 1970s. I didn't say this before. We actually don't allow currencies to convert just after the Second World War. We freeze them all. Currency convertibility isn't restored until 1958. So then we can start to move money around, and we can start to exchange currencies from one currency for another. 1958. So this is the beginning of the Euro loan market. What then happens very quickly is we get a parallel bond market, a Euro bond market. Now, any Dutch people here? Anybody know what this is? What's this? I've actually got an English translation of it, which I'll need to put on my document as well. This is actually one of the earliest bonds. I think it's Dutch. I think it's Bank of Amsterdam. It was 1609. This one is the Autostrade. This is what built the motorways in North Italy just after the Second World War. This was the first Euro bond ever. I'll give you the real certificate. I have a full one. I'll give you one as a present. And if you can read it, it says S.G. Warburg, something like 3.5% over LIBOR. This is the first Euro bond ever. It was 1953, 1963. So we get parallel markets. We get a loan market, syndicated lending, and we get the bond market. And then the subsequent history, as I said before, is the medium-term note and Euro note market, and then the commercial paper market. Notes generally 1 to 20 years, paper up to 1 year. Paper could be 7 days, could be 30 days, could be 60 days. If it's very short and it's floating, we call it paper, commercial paper. If it's 1 year to 20, we tend to call it a note, although strictly speaking, a note means it's floating rate. Anything else is a bond. Bond is fixed or anything over 20 years. Now, financial derivatives. So again, we talk about early 1970s, there it's there, the collapse of the Bretton Woods system. So we create massive new forms of currency risk at the beginning of the 1970s. The modern world we live in was created in 1971 by Richard Nixon, just before Watergate, when he got removed because of certain unpleasantness. So all the main international, the word derivative markets, but they tended to be American domestic ones, like the Merc, the Chicago Mercantile Exchange. I visited there. The Chicago Board of Trade, we call that the CBOT, the Chicago Board of Trade. You used to be able to go in them, visit them. See the CBOT there? And the Merc. You used to be able to go in and visit them, go into the visiting gallery and watch everything. It was great fun. Because they're open outcry markets, so all the men wear blazers in different colours, and then they all do this all day long, right? It's great fun to watch. And you used to be able to go to the gallery to watch them do all this. Now, after 9/11 and all the dreadful things in America, you can't get near these buildings. It's soldiers with guns, and you can't even get, the blocks like cordoned off, and then there's all these steel reinforced structures in the road so that you can't drive cars into them. I mean, a lot of dreadful things have happened recently in the world. I used to be able to walk into these buildings, go straight up to the gallery, have a cup of coffee, and watch everything. You can't get near the buildings now. So financial derivatives, market size, we talked about this before. Credit derivatives are the new type of derivative. Most derivatives early began as a form of risk management. They then became used for speculation purposes, basically trading to make money. The key forms were the swap, the future, and the option. A swap is when you exchange something, one currency for another, one commodity for another, fixed interest for floating rate interest. You swap something. And that's the main document, the master agreement, the ISDA that we'll do in the second term. And I gave you the outline today for those of you not doing the second term. A future is an obligation to buy or sell at a future time, amount, and price. Those tend to be exchange traded. Swaps are OTC, over the counter. Futures tend to be exchange traded. It's an obligation to buy or sell at future time price. Future time price. Now this could be anything. This could be cocoa, steel, another security, anything, another derivative, anything. You can have futures on virtually anything in the world now. An option is a right to buy or sell. It's your decision, it's your election. It's an option to buy or sell at a future time, price, and amount. And these are three of the most important markets in the world. They were originally developed for hedging purposes to manage risk, either in the foreign currency market, and then the interest rate markets, and then later the commodity markets and everything else. You can now get derivatives for anything. You get weather derivatives, you get environmental derivatives, you get anything you could possibly imagine. It's basically an alternative form of insurance, issued in the form of a security rather than insurance. A more recent extension of this market is called the credit derivative market, which really grows 1990s, 2000s onwards. A credit derivative is a specific type of derivative whereby you effectively guarantee a payment. So what will happen is this. If you're one of the biggest banks in America, let's say Bank of America, lending to one of the biggest companies in America, let's say Ford, you're worried Ford's going to repay you, pay you back. So what you can do is this. You could go to an insurance company and get insurance, or you could go to a guarantor and get a guarantee, or you could buy what's called a performance bond, which is virtually the same thing. Or what we invented in the 1990s are these credit derivatives. They're basically the same thing as an insurance, as a guarantee. What will happen is this. Bank of America, when it lends to Ford, it will be worried that Ford won't repay. So what it will do is it goes into the market and buys credit derivative protection against Ford. Now, anybody know why you would do that? It limits your risk, but there's another reason, very important reason. It's called capital adequacy. And we'll spend a lot more time on this in banking law because it's very important, but it's actually very important in all markets for all purposes. What actually happens is this. If Bank of America lends 100 million to Ford and it's unsecured, uncovered with nothing, it has to cover minimum capital against that. So it has to keep minimum 8% capital, more likely in America 12, 14% capital against that loan. So although it's lending to Ford and it's charging Ford a premium on lending to Ford, it's also got to keep capital in case Ford doesn't pay to cover the losses, do you see? It has to keep a capital reserve against that lending to Ford. And this all deals happens everywhere, all around the world, at all times. But what happens is this. If you buy credit protection in the form of a credit derivative, in the most common form is called a credit default swap, a CDS, guess what happens to your capital? It collapses by a half, if not a quarter. So, what does that mean? If your capital goes down by a quarter lending to Ford, what do? You lend Ford four times as much. You make 4 times the profit. Why? Because you bought a small bit of credit protection with a credit default swap to guarantee Ford's obligations. Is that not clever? That's how these markets work. So then there'll be derivatives and all the rest. Okay? So that's the Eurodollar markets, that's London, that's the international financial system. Next week we're going to do this. I've given you on the back of your outline, you've probably got this version. These are all the main markets in the world. And we'll go back over this. We'll spend 2 hours next week on this. The money markets, primary, secondary, the gilt markets, banking markets, deposit taking and loan markets, the capital markets, securities and capital, the derivative markets, 1, 2, 3, 4, I've just mentioned. There's the credit derivatives, there's the CDS there, credit default swaps. Alternative investment markets, we'll talk about this next week as well. Hedge funds, private equity, sovereign wealth funds. These are new, higher return markets that really grew up in the 1990s and 2000s. We'll also look at the foreign currency markets, gold market, insurance markets, and commodity markets. We'll understand the whole world on one table with the City of London paper you've got, right? So we'll do all that next week. Now, what have we got? 10 minutes left. So let's go back to this one. So this is a general introduction and overview for the whole course. What we're looking at, history of banking and finance, the international financial system, and we can, I won't go through, we did this earlier slightly, we've done a bit of it already. Origins of banking, origins of finance, trade and merchant finance, merchant banking, investment banking. The only thing to stress is this. There's three key terms you need to know. Commercial banking, international banking law is principally about commercial banks. What is a commercial bank? What does a commercial bank do?
Deposit and lending.
Yeah, very good. Almost perfect. A bank takes in deposits from the general public, it pools them and it on-lends them. Okay? The technical definition in Article 3 of what was the first banking directive, then the second banking directive, and now the Capital Requirements Directive 4, is it's any institution that accepts receivable funds from the public and lends on its own account. That's the technical definition of banking under European law. It's a very good definition. The only thing is, it's not a definition of banking. It's the definition of a credit institution, because it's Europe in European institutions. They don't define banks in banking. What they define is credit institutions. So they treat all banks as being credit institutions. So in Europe, you don't actually have any banks, because there's no definition of banks under European law. There's a definition of a credit institution, and there's a definitions of financial institutions and securities firms, but not of banks. The closest definition is credit institution. That's whereby you accept deposits from the general public, you pool those, and you on-lend them. And what I'm going to give you is this. I'm going to give you a bank balance sheet. And we'll do this in the tutorials. Because we'll do money and then two fintechs first, we'll probably do this class 4, 5, and 6. For the tutorials, between 4 and 5. We do tutorials between 4 and 5 after banking law. Then we have a film club between 5 and 6. And then we start international finance between 6 and 8. So even if you're not doing banking law, you're welcome to come along at 4 or films at 5. Entirely up to you, okay? I will put the balance sheet and the recordings on the system as well, so you can understand them in this class, okay? It just gives you a better idea of what a bank is. You don't strictly need it for this class, it's more for the other one, but if it helps you, I'll give it to you. Now, a commercial bank takes deposits and lends. What is an investment bank? We did this earlier. This is an American term, it's an accident of American English. An investment bank is basically a securities house. It's a securities firm. It only does capital market business. Now, what is that? What does an investment bank do? Investment banking.
Well, for example, to buy bonds or equity or IPO or doing IPO and so on.
Yeah, so I summarize all that in the text. An investment bank, initial purpose is underwriting. So whenever a government or a company wants to issue securities or debt, it will be underwritten. And what that means is this. What they can't sell to the general public, the investment bank buys up. If you're going to issue 100 million shares or bonds, you want to make sure they're all bought. So what you will do is, you'll issue them, but you'll have an underwriter ready, Goldman Sachs, Morgan Stanley, who will buy up anything that's not sold to the general public, okay? That's underwriting. They'll also advise on, they do corporate advisory work, so they'll advise on mergers, acquisitions, IPOs, and initial public offering. If you're a private company, you become a public company for the first time, you want to sell shares to the public for the first time, you call it IPO, initial public offering. When we do fintech, we'll do initial coin offerings. That's how a lot of the new coins have been created. I actually have my own coin called ClickCoin, and I may have my own ICO. So I may raise myself 10 million. What did Tezos raise? 230 million, was it? 245 million, yeah? Amazing. ICO a couple of 2 months ago. We'll do all this in the FinTech project if you're interested. Investment bankers also do foreign exchange business, they do trade finance, they do bills of exchange, they do anything which is capital market and non-pure commercial banking. All of these different activities. And they're very profitable, they can make an awful lot of money, but it's much higher risk. That's investment banking. Does anybody know what a merchant bank is? So commercial bank, investment bank, merchant bank. What's a merchant bank? A merchant bank is an old-fashioned British bank that used to do both commercial banking and initially trade finance, which then became investment banking, but it does both. The difference between an American investment bank and a commercial bank is investment banks don't have bank accounts because they don't take deposits and they don't offer current accounts, checking, and this type of stuff. So if you go to Goldman Sachs, you don't get a bank account. You will have accounts of a different form. You may have a securities account, a foreign exchange account, but you don't have like a bank account. An investment bank is not a bank. A merchant bank can do both. It was an early English trade finance bank that did bills of exchange, foreign exchange, that grew out of the early, remember I talked about goldsmith bankers in London. Goldsmith banks in London, people would deposit their gold and silver with a goldsmith and he would issue a receipt. Those then became early bankers in the 1640s, 1660s in London. Goldsmith banking. They then become what are called trade finance because they're going to finance trade, domestic trade and international trade, mainly through things like bills of exchange, promissory notes, that type of stuff. Those then emerge into merchant banks because they do both banking, commercial banking business and securities capital market business. So, three key terms. A commercial bank only does deposits and lending. An investment bank only does capital market work. A merchant bank is an old British bank which does a bit of both. Okay? So, I then look at international financial system. I summarize the gold standard, Bretton Woods, what's called the petrodollar markets, debt crisis, that's the early 70s, early 80s, Asia-Russian crisis, and then the credit crisis, 2007, 2010. You don't need to know a lot about this. This is just background. The other class, we go into this in a lot of detail. I then look at the international financial markets. We'll do all this next week. Money markets, capital markets, Eurodollar markets, derivatives markets, currency markets, gold market, commodity and insurance markets. We'll do all of this 2 hours next week. And then, this was quite good fun. I was trying to work out what all the financial assets in the world were. And I like simple numbers. I like 5s and 10s, and 5 by 5 is 25. So I came up with a simple structure. All the main financial assets and instruments in the world, I summarize 5 by 5 by 5. Coinage and currency, credit and payment, debt, securities, risk and investment. Basically derivatives and insurance. It's all in here. So 25 of the key assets in the world. And if you understand that, you'll understand most of finance. Just very important small core part. Again, we'll try and do that next week because we'll try and work out the markets and then the assets in the markets and see how they map over one another. We then look at international financial centres in London, and I explain why London's still important. In international banking, 20% of all international banking is still done here. Very large part of all investment banking is done here. Bond market, I think 60% of the international bond market is still in London. More equities, foreign equity listings, dual listings are in London than anywhere else in the world. Foreign exchange, 65% of all the foreign exchange trading in the world goes through London every day. This market is worth $5.3 trillion. 60% of that is in London every day. Financial derivatives markets, we did this already. This market's worth $700 trillion. Huge part of that, the largest part of the OTC market is all in London. London and Edinburgh are always very famous, also very famous for asset management. All the biggest banks in the world who specialise in this, like the big Swiss banks, are all in London as well, because this is huge business. Gold bullion is based in London at NMM Rothschild. The international insurance market and reinsurance market is based in London at Lloyd's. Marine insurance is based at the Baltic Exchange in London as well. All of the main markets in the world are all in London. I haven't even included the oil markets, the commodity markets, and 90% of all commodities in the world are traded in London in the London Metal Exchange. Huge part of the international oil market, all traded in London in the International Petroleum Exchange in London. Now, I then go into this in a bit more detail. Investment banking, these are all the key activities of investment banks. Equity and debt underwriting, market making and trading, asset management, advisory services, trade finance, foreign exchange and derivatives, prime brokerage and other activities. What's prime brokerage? That's working for hedge funds. All the biggest hedge funds in the world, and we'll do this maybe before Christmas, I'll give you a chapter on this. I have a big chapter on hedge funds. Each of the large hedge funds has its own banker. And And what does it do? It basically does all of that. It does trading, it does lending, it does foreign exchange, derivatives. A prime broker does all the ancillary services that a big hedge fund needs. That's called prime brokerage. This became enormous business just before the crisis. Who was the largest prime brokerage firm in the world? What was the largest prime brokerage firm? Lehman Brothers. Lehman was the one that collapsed. So a lot of people thought, I'm not mentioning any names, such as French politicians like Sarkozy, that the global financial crisis was caused by the large hedge funds. To a large extent, the hedge funds were victims of the crisis because the largest prime brokerage firm was Lehman. And what happened was Lehman collapsed, so all of their cash and equity securities were tied up for a year, 2 years. A lot of these funds closed. They were actually victims rather than causes of the crisis. And then investment banking, so I summarized the US investment banking market. Glass-Steagall's in there, JP Morgan Chase, Morgan Stanley. What's the biggest investment bank in the world? Always has been. Most famous? Goldman Sachs. Who's number 2?
JP Morgan.
No, JP Morgan's a bank, commercial
Morgan
bank.
Stanley, sorry.
Morgan Stanley. 3, Merrill Lynch. 4, it was Lehman. 5, it was Bear Stearns. Bear Stearns gets bought by JP Morgan Chase in February 2007. The Americans wouldn't rescue Lehman on 15 September 2008, and that's what causes the global financial crisis. Lehman was systemic. It was a globally important institution. When it collapsed, it was going to bring the rest of the world down. But the Americans took a bet, took a gamble. They thought it won't. The actual argument was, oh, Bear Stearns was all right, but what happened to Bear Stearns? That was number 5 on Wall Street. Bear Stearns was bought by one of the biggest banks, second largest bank in America, JP Morgan Chase. It was bought out. Who bought Lehman? Nobody. Lehman was allowed to collapse. What actually happened was Bank of America under Ken Lewis was meant to buy Lehman. But what happened was the head of Merrill Lynch, he said to Bank of America, buy us instead. So Bank of America merges with Merrill Lynch. So who was meant to buy Lehman? Barclays Bank. But Barclays Bank couldn't because of some complications in British company law. They had to get consent, and there was no time to get the consent. So basically, the Americans let Lehman close without bailing it out. That's what caused the global financial crisis. So how did commercial banking cause the global financial crisis? I still don't understand. Everybody said that for the last 10 years, and I still don't understand it. It was caused because the Americans allowed the 4th largest securities house on Wall Street, which is not a bank, to close down. Now, we'll actually do that in the international banking class for 3 hours next week, between 2 and 5, if you want to come along. So, just to finish up, I also summarised British merchant banks, continental European banks, Japanese securities houses, the 4 biggest Japanese houses. I then look at international commercial banking, international financial markets. I summarised the rest of the course. Euro loans, Euro bonds, project finance, securitization, financial derivatives, everything's on there. Whole course, one document.